Very warm greetings to everyone. I hope everyone is safe and healthy at their places. Myself, Nishi Pathak, associated with Department of Management Studies at Rajkumar Goyal Institute of Technology, Ghaziabad. Today, I am here to discuss and initiate the first unit of our subject, Investment Analysis and Portfolio Management, that is the first subject of the specialization of finance. I am here to discuss over the overview of capital market, that is the market of securities, basically bring out a basic introduction to everyone what is capital market all about. So, let us begin with our presentation. Now, before I proceed with this capital market, I would like to discuss a bit of affiliation of this term capital market. Now, if we talk about any lively economy, it is just because of its strong financial system. Financial system acts as a blood in the economy. सेम तरीके से जिस तरीके से हमारी बॉडी में इम्पोर्टेंस होती है ब्लड की, इट मेक्स आवर बॉडी लाइवली, सेम वे द फाइनेंशियल सिस्टम ऑफ any of the economy makes it lively. Here a terms come that is known as finance. Finance is actually a bridge between the past and the future of any economy, and a financial system helps us in making this particular bridge. Now, when I try to feature the functions of the financial system, the first and the foremost one is mobilizing the savings of the people. Mobilizing these savings where? Channelizing these savings to the industrial investments, the people who require them in the industry, and also stimulating the capital formation so that the process of economic growth is stimulated. The growth rate increases of the economic development. And all this, a financial system does it with the four major constituents, that is your financial market, financial institutions, financial instruments and financial services. These are the four major constituents on the basis of which any of the financial system works. But we are not going to discuss the whole of financial system. Our subject pertains ourselves as limited towards the capital market. So, we will proceed with it. Before we proceed towards the capital market, let us discuss something about financial market. That is one of the major constituents of the financial system. Now, financial market is known as the backbone of the economy. Why? Because it is actually supplying the monetary value to the economy. It is acting as a catalyst. It is acting as the agent that would bring the economic development. And this financial market, how will it supply that monetary value? It will take help of its two markets, that is known as the capital market and the money market. Now, let us discuss the difference between the two. Here we have the capital market and here we have the monetary market. Money market. Money market, money market is actually a short term market. The maturity of the instruments is normally for less than a year. Who are the participants? The participants are the banks, the financial institutions. Why do they use these money market instruments? They use these money market instruments in order to maintain their liquidity, in order to maintain their liquidity crunches that can happen. Now we come to the capital market. Capital market is actually a long-term market, of which the instruments that exist have a maturity of more than a year. Who are the users? Users are the individual investors through brokers, or we could have institutional investors, and the third most important user of capital market is the companies, the business houses that require long term capital. They are the ones who want a source of long term capital, and they enter the capital market to find this long term source of capital. So, this is the major difference between the capital market and the money market. Money market के अगर instruments की हम बात करें, they are the major ones are the treasury bills, we have the commercial papers, we have certificate of deposits. Capital market की अगर हम बात करें, they are the equity shares, we have the preference shares, we have debentures or the bonds. These are the major instruments of capital market and of money market as said. Now, when capital market comes into our mind, we have a number of words that crop up. There are a number of synonyms that we remember, like share market, or it could be stock market, it could be securities market, and the second word that comes up is the risk. Once we talk about shares, as and when shares come to our minds, what comes the second thing is risk. We are not thinking about the long term gains that we can have from this capital market, but we are thinking shares, we are thinking risk. But are we really at risk when we are investing in capital market? I do not deny the fact that yes, share market is risky, but if done with proper analysis, it could be fundamental, it could be technical, by studying the past history of the share markets, in that case long term association with the capital market can give us high returns also. We can earn high profits on it also. So, if I try to define a capital market is a place like normal market, any normal market that we have. It is where the buyers and sellers are coming together in order to purchase something and sell something. So, something over here is the shares, it is the debentures, the bonds. So, the buyers and sellers are coming together in order to purchase or sell the instruments that are prevalent in capital market. That is known as a capital market. Now, this capital market also, like any other market, works on the forces of demand and supply. More the demand, more goes the prices, and the effect of these two forces, the demand and supply, can make the market rise and make the market fall. Now, when we see a capital market, we have its two of the classifications, primary market and the secondary market. These are not two other markets, two different markets, but they are distinguished on the basis of the activities. When I try to focus on the primary market is the market in which maybe new companies are coming up with their shares, with their investment instruments, or the existing companies want to increase their share capital, they want to increase their capital, and that is why they are floating in new shares, new instruments into the capital market. So, the main focus over here is what? The main focus over here is the new shares that are coming up in the market. It could be because of the new companies that are coming up, that are registering themselves, listing themselves, or it could be just because of the existing companies want an increase in their capital. So, the focus here becomes the new shares. So, whenever those new shares are coming into the market, they are being issued, they are being offered to the public, they become the part of the primary market, and it is also known as initial public offering. the new issue market. This of the offers that are brought in the form of shares and debentures, they are known as the initial public offering. When the shares that have been issued gets started trading, the buying and selling of these shares starts happening, that becomes a secondary market. The shares that are purchased in the primary market are sold to someone, some other investor is buying it. So, this buying and selling starts happening again and again, that becomes a secondary market. So, we do not have any physical spaces separately for primary market or it is for secondary market. It is just because of the activities that are existing. Next thing that we have is the instruments of capital market. Every market has some instruments, has some products or services that it would be dealing in. So, the most important instruments that are being used in a capital market are of three types. We have it as equity shares, we have it as preference shares, we have it as debentures or bonds. Now, first let us focus on the equity share. Equity shares, if I define these equity shares are the small denominations in which the capital of a company is divided into. Those become the equity shares. There are a number of features that are pertaining to equity shares. The first one is they have voting rights in the resolution of the companies. Then they are also known as the owners of the company with the amount of shares they are holding. They have preemptive rights. Preemptive rights are the rights that is popularly known as right issue, in which if a company is going to bring in further capital, new capital, it is going to issue further shares for the increase in the capital. In that case, what is going to happen? In that case, these existing shareholders are given the first chance to purchase these shares before being offered to the general public. That is a preemptive right. Then they dividend on these is not fixed and they get residual profit. I will take both the points together. When we are talking about the profits, equity shareholders get the residual profit or they get the residual income. What does that mean? That means first the profits of the firm are distributed to the debenture holders, then it is given to the preference shareholders, and finally whatever is left is provided to the equity shareholders. So, if larger amount is there, equity shareholders will get good profits. If there is small amount of profit left for the equity shareholders, they are going to get lesser of the profit, and if no profit is left, they are not going to get anything. So, those are the features of equity shares. They do not have, that is why it is said that they do not have any fixed dividend that they are going to get as return. Now, another feature of this is they are not redeemable. They are not redeemable. What does this mean? That means they do not have any maturity. They would exist till the company does not winds up or it does not liquidate. They would have to exist till that time. So, they are perpetual in nature, if we say it in other words. So, these are the basic features that make the equity shares totally different from any other investment options of the capital market. Now, if we focus on the preference shares, The preference shares, as the name suggests, it has a preference over the equity shares, right? And the second thing is they have a fixed rate of dividend that they would get. Those are the two points that define a preference shares. The name itself suggests the preference, so they are getting preference over the equity shares, and the second thing is that they have a fixed dividend rate that they are going to get. Now, when we talk about the features of preference shares, like equity shares, they do not have any voting rights. First and the foremost things, they do not have any kind of preemptive rights, the right issue, or they do not have any such features of getting bonus shares. Yes, what is the feature that they have? They get a fixed rate of return. Suppose if we have 10% preference shares, that means they are going to get 10% of the preference, the rate of return would be 10% over these particular shares. Now, we come to the debenture or the bonds. When we were talking about the equity shares, preference shares, they were shares, and on shares in the form of the rate of return, we get dividends. Now, we come to the third category, that is known as debentures or the bonds. Debentures or bonds have a very thin line difference between them. But before that, let me explain what is debenture. Debenture is a type of debt, or it is a type of loan that has been taken by the companies from the general public. They have a fixed rate of interest. Like on shares, the rate of return was dividend. But when we are talking about debentures, the rate of return that they have is interest. They have the fixed rate of interest, and company is liable to pay these debentures when and then they are due. Debentures are debt. They are a type of loans that have been taken. They get a preference over the shares. So, that means from the profits of the company, first we are going to make the payments of profits in the form of returns to the debenture or the bonds at the fixed rate of interest, whatever has been decided. Then we are going to make it to the preference shares, and if left, then we make it to the equity shares. Now, let us see what is the difference between debenture and bonds. Debenture and bonds are having a very thin line difference. Second thing is, we can use their names interchangeably. They can be used as synonyms also. They are used as synonyms also, in fact, right. So, what is the difference? When we are talking about the debentures, debentures are basically the debt or the loan that are taken by the joint stock companies, and bonds are the debt or the loans that are taken by the government or the public undertakings. That means bonds are issued by public undertakings or the government, and debentures are issued by the corporates or the joint stock companies. So, these are the three major instruments of the capital market in which the people usually invest. Every instrument has its own advantage and disadvantages. It has its own terms and conditions. Whatever the feature I have discussed, whether it is for the equity shares, whether it is for the preference shares, whether it is for the debentures or the bonds, they have certain terms and conditions that have to be fulfilled, and then only you can enjoy the feature that it has. So, everything that is happening in capital market is having certain terms and conditions. It has the regulations that you have to follow in order to get the benefit out of it. Now let us discuss the functions of capital market. Capital market, the securities market, the share market or the stock market. What are the basic functions of capital market? The first and the foremost function that goes on is that it helps in channelizing the savings of the people. Capital market is the medium through which the savings can be invested of the people, and they can earn profits in the form of the return that they get from it. Second is the assists in financing of long-term projects of the company. Every company, it is not possible that they can have capital of their own. They require long-term sources. Now, to have those long-term sources, they seek the help of capital markets. They can easily, following the conditions, following the rules and regulations, they can go and seek help of capital market. They can issue shares and get the long-term source capital from the general public through public issues and whatever options they are using for the gathering of that capital. Then it gives an option to the investors to have a number of productive assets in which they can invest. The next is it minimizes transaction cost. Transaction cost, it could be in the form of the brokerage that you are paying, all those cost that is involved in buying and selling of these shares in the capital market. This can get reduced just because of volumes of trading. More the volume of trading, less would be the transaction cost. More the people who are trading, it would affect the transaction cost. Then the next 2 points focus on the liquidity. The capital market helps in maintaining this liquidity because the shares, the instruments that are being purchased can be easily bought and sold, and liquidity crunches can be avoided. As and when I require money, in emergency I can go and sell out my shares and dig out the money whatever I have invested. The capital market has a proper regulation over the activities of the capital market. So, these are the various functions of capital market. Next is, it is not that capital market is not affected. It gets affected by everything that is happening in the economy. The capital market, the secondary market, is said to be the mirror of the economy. By mirror of the economy, we means whatever is happening in the economy, maybe a small thing or a big thing that is affecting the economy, will show its reflection in the capital market also. It may rise, it may fall just because of those activities happening in the economy. So, that is why capital market also gets affected by various factors that are existing in the economy. Let us have a look at them. The first and the foremost one is performance of domestic companies. Now, when we are talking about capital market, obviously capital market is what? It is made up of the listing of the domestic companies, listing of the companies over it. And obviously, the performance of these domestic companies would affect the capital market. अगर किसी भी डोमेस्टिक कंपनी की प्रोडक्ट की डिमांड कम हो जाती है, उसकी मार्केट वैल्यू गिरने लगती है, तो कैपिटल मार्केट पे वो उतना ही इफेक्ट करेगा. कैपिटल मार्केट में भी द पोजीशन वुड गो डाउन. The same thing happens with almost all the companies that have registered themselves. So, to have a very good capital market, a strong capital market, the good performance of the domestic companies is also important. The second and the important factors pertaining to this time, the current time, is environmental factors. Today, when we talk about the environmental factors, I need not give you examples of past. I can give you current examples. We have two situations. One is drought, one is flood. There are so many areas where there is flood that is there. It is playing havoc in those areas, whether you talk about Kerala, whether you talk about Mumbai, where you are talking about the areas of Bihar. They are affecting. They are affecting not only the agricultural activities, but also the other business activities. So, obviously, it is going to affect the performance of the companies, the performance of the various sectors. When I talk about drought situations, where you have less of water available, सूखा पड़ जाता है, obviously it is affecting the agricultural areas. जैसे ही agricultural area affect होता है, उससे related, उसके ऊपर dependent जितने भी businesses हैं, industries हैं, they get affected. When these industries get affected, obviously your capital market would get affected. Leave aside all these things. Let's talk about COVID-19. The spread of COVID-19 has Again, I'll say the same, it has played havoc. There was a time when the demands of the products was falling. That was affecting the businesses. So, that is another environmental factors affecting the performance of the capital market. Then we have macroeconomic numbers. Macroeconomic numbers, you could have the wholesale price index, you could have the numbers of the imports and exports, you could have the industrial growth rate. When the things are positive, you have high industrial growth rate, your economy is doing well, so your capital market would perform well. But when we are talking about the degrowth of these things, we have more of imports, we have less of exports, obviously your economy is being affected. Again, economy gets affected, the capital market gets affected. Then global cues. In the time of globalization these days, the countries are interdependent on each other, at the same time interconnected. So, whatever around the world happens affects the particular economy. All the economies that are connected to that affected economy, that are dependent on that affected economy, also gets affected. So, that is another reason that could affect our capital market. Then we have the political stability and government policies. If we have a stable government, the confidence of the people increases. Confidence of the people increases, they try to invest more. What happened in the case of 2014? When we had the clear majority government, the Modi government, the market went up. I do not say it was because that the ruling party was BJP, that is not the reason, but yes, the confidence of the people increased because we had a majority, the government that was in majority and not an alliance. Now, in this case, if the stable government is trying to work hard for the betterment of the people, it can do it freely. It is not dependent to take decisions with the other people who are associated, right. Then the next point is the investor sentiments and risk appetite, the nature of the investors. Investor has savings, but he is not ready to take risk, he is not confident at all, he is not going to invest, he is going to keep the money in its in his own lockers because he finds it safe over there, right. Whether we have risk taking investors or risk averse investors, risk taking investors would invest, obviously they want to earn more and more of profits with taking high risk, but when we are talking about risk averse, they do not want to lose their money, right. They do not want to take risk. So, they are going to maybe invest in ventures that give them fixed rate, maybe they can invest in FDs and all. Why will they go to capital market? So, these are the factors that affect the capital market. Now, if I ask everyone, do we have any impact of COVID-19 spread on capital market? The answer would be a big yes. Why? Because COVID, when it came, the global economy was already showing a slowdown. It was already showing signs of slowdown. Then when it came, the two big forces of demand and supply played their roles. It has shaken the financial markets. When I try to talk about the data about BSE, the Bombay Stock Exchange, around 20th Jan 2020, it was around 40,000 points, but when we talk about somewhere in April, it went down to around 29,000 points. Now, what was that? That was the fallen market. The price earning ratio on the shares that usually ranges from 20 to 24% came down to 17.8 or something, or around 18%. That was the decrease in the price earning ratio, right. So, obviously, the COVID has impacted the capital market, it has impacted the business, it has impacted the working of the banks, it has changed the scenario, it has brought in liquidity crunches all around, whether we talk of individuals or any of the financial institutions. So, this is how the COVID has affected the capital market also. Obviously, when the business of the economy get affected, the capital market gets affected. So, with this I conclude my lecture that was based on the introduction of capital market, the overview of a capital market. Thank you everyone.